Hey Bowtie Nation, Joseph Hogue with your weekly stock market update coming to you on Sundays at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, just 2 months ago, investors were panicking. Today, after a 19% rally, they're acting like stocks can only ever go higher. That's exactly when mistakes are made because the biggest threat to your money isn't the next crash, it's waiting too long to be ahead of it. I'll show you why I'm starting that process right now, what I'm buying to keep growing my portfolio, but also protect it, along with important updates to Broadcom, ticker AVGO, CrowdStrike, and all the cybersecurity stocks. Before we get to that, I'm going to be updating my entire portfolio on the Blossom Investing app tomorrow, so if you haven't yet, use the special invite link below to join me and see every stock in my portfolio. It's totally free to use and helps support this channel, so I appreciate that. Plus, you're going to get to see what over 500,000 investors are talking about in the social feed. So look for that invite link below or just scan the QR code here. Back to those stocks to buy now though, because Nation, with stocks like Dell up 250% over the last year and 28% on Friday alone, with SanDisk, ticker SNDK, up 42 times your money in just a year, everyone wants that next hot AI stock, but, well, I guess for some of you, I'm old enough to be your dad, so I'm going to have to go with tough love you need instead. I did say that stocks were a steal in late March, with the S&P 500 down 8% to 6368 on that index, and trading for under 19 times this year's expected earnings for companies in the index. Stocks have now surged 19% in less than 2 months, with tech stocks up 34% in the 3 months alone. And in that time, the Fear and Greed Index, a measure of how stretched the market is on a short-term basis, has gone from extreme fear, almost the lowest I've seen it, back to a clear greed signal where investors think stocks only ever go up. And that stock valuation I used to show stocks were a great deal, then trading for 19 times earnings, is now back to as high as it's been since the 2021 crash. That's no longer so great. Now, I'm not saying stocks are crashing tomorrow. Even if we get the normal 5 to 10% correction we get every year, the AI-driven bull market is likely to continue at least through the end of the year. But here's the problem, and you know it. We always want to ride out those high-flying stocks for just one more year. We get those dollar signs in our eyes and think, yes, there will eventually be a crash, and I am ridiculously, tragically overinvested in tech and the riskiest growth stocks. But if I can just make bank for one more year, I'll have enough money to tell my boss to F off, and then I'll diversify my portfolio, take some of those profits in the risky stuff, and start adding those safer stocks to protect from that eventual crash, and then just chill by an island beach somewhere. But then that rebalancing never comes, does it? I should know. I didn't do it myself in 1999, didn't do it again in 2008 or in 2021. Each time I had too much in the riskiest stocks and not enough in those safer stocks, and I paid the price in every crash. From more than 200 portfolio reviews with you out there in the nation, I know you're in the same place. More than 90% of your money in stocks, and almost all of that in those tech and growth stocks that are doing so well right now. But Nation, right now is the time to start rebalancing. When the overall market fell 8% in March, the tech-heavy Nasdaq fell 9%, while AI-related stocks in that AIQ ETF lost 10%, and shares of Nvidia plunged 13%. Causing many investors to panic and sell at the worst possible time. Now hold up, I'm not saying to go 100% in cash and bonds, not even close, but with tech stocks up over 170% in the last 5 years, the overall market up 80%, it is time to start looking at the risk in your portfolio and not wait until after the next crash to wish you did. So my recommendation here, if you have more than 50% of your stocks or assets in tech and those riskiest growth stocks, all those high-flying stocks everyone says is going to make you rich, take some of those profits and use the money to spread your risk in these 9 ETFs and stocks that are going to give you a more diversified, safer portfolio. Again, you don't have to sell out of all of your tech stocks. Sell it back down to maybe 40 or 50% of your portfolio, still leaving a big part in that growth that's going to make you rich, but then diversifying into these stocks instead. And here you can start by adding something in the consumer staples sector, up just 8% on the year. And I know some of these stocks have been a dog for so long, but these are companies selling things that we have to buy, no matter what, like food, beer, and cigarettes. Okay, some of these are more must-buy than others, but all are companies with stable cash flows, no matter what the economy does. Here, the easy choice is the State Street Staples Select ETF, the ticker XLP, which holds all 36 companies in the S&P 500. The largest staples companies in the United States, and is a good overall investment. Or I highlighted packaged foods names like General Mills, GIS, and the Campbell's Company, CPB, last week as solid, long-term safety plays. Real estate stocks have started to rebound this year, but are still up only 2.6% over the last 5. Not only is there still a lot of value ready to come out in these 31 names held by the Real Estate Select Sector Fund, the XLRE, but it's also a good inflation hedge and a cash flow generator that's going to protect you in a tech sell-off. Oh, I've recommended the data center REITs like Equinix and Digital Realty Trust in the past, but those are a little too techy for diversification. Instead, besides the overall fund, you might consider shares of American Tower, ticker AMT, Invitation Homes, INVH, and Prologis, ticker PLD. The healthcare sector has lagged this year, with stocks down 2.5%, but few groups are as necessary in spending as this one, and valuation is looking attractive. On a price-to-earnings basis, the sector is the third least expensive of the 11 sectors. Here we can see the current PE ratio in blue here against the average longer-term ratios. Stocks in the healthcare sector currently trade for that price of 17.3 times expected earnings. That means investors are paying just $17 for every dollar in earnings expected to be generated over the next year, right at that 5-year average, and very attractive given premiums as high as 10 and 25% on some of these other sectors like tech and industrials. Now here you can pick through some of the separate industries like pharmaceuticals, medical devices, and insurers, but the easiest path is just going to be to buy the whole Healthcare Select Sector ETF, the ticker XLV, which holds all 60 stocks within that group. That's going to give you the largest healthcare names in the United States, like Humana, CVS Health, Merck, and Eli Lilly. But don't forget the dividend stocks with the Schwab US Dividend ETF, the ticker SCHD, which, even though it's lagging tech, is posting a very respectable 24% return over the year, on top of that 3.3% dividend yield. This fund just finished its annual reconstruction, adding some higher yield names, which should help boost that dividend. These are long-time dividend growers, and while there's some tech growth here to help those returns, most are in more stable sectors like healthcare, consumers, and financials. Now turning it over to the stocks I'm watching this week, cybersecurity stocks diverged after I recommended them in last week's update video, with Okta Inc. jumping 27% after reporting its earnings and revenue that beat expectations, calling out the coming AI-fueled cybersecurity demand that I pointed to earlier. CrowdStrike and Palo Alto both continued higher in sympathy, and Fortinet closed at about 2.7% gain. But shares of Zscaler, ticker ZS, were the big laggard here, falling 33% on Thursday. The company beat earnings and revenue forecasts, but guided for only a 17% year-over-year earnings growth for the next year, which was under analyst estimates. Zscaler is one of the least expensive stocks in the industry, but as I pointed out last week, probably the most exposed to any AI replacement of software. I own the stock, and in fact, bought another 120 shares on the drop because I think management is just being overly conservative with that forecast. My position in ZS is down about 15% against strong upsides in CrowdStrike, Palo Alto, Fortinet, and Okta Inc. Nation, this continues to be my favorite theme in the market, what I've been saying over the last 6 months, and what we've heard from Palo Alto's head of product 2 weeks ago, that AI is going to bring a wave of cybersecurity demand that is going to push revenue higher for these companies. And continuing with that theme, Palo Alto Networks, ticker PANW, is the next cybersecurity company to report when it releases earnings on Tuesday. The largest company in the space by market cap is expected to post 28% revenue growth, but flat earnings for the quarter over the last year. That forecast for flat earnings at 80 cents a share is a low bar that should be easy to beat, as the company is one of the few with higher profitability, posting a 15% operating margin. I like this company and hold the shares, but I'm going to be watching those earnings report closely, because if it does look like PANW's profitability is slipping, it could be a warning sign for the stock. And CrowdStrike Holdings, ticker CRWD, follows with its earnings on Wednesday, and my favorite cybersecurity company. CrowdStrike has by far the best product with its Falcon platform, and is leading in AI cybersecurity as well, one of only 2 companies along with Palo Alto that got an early look into the Anthropic Mythos model. The company is expected to post 23% sales growth for the quarter and the full year, along with solid 30% earnings growth from last year. That higher earnings growth makes it one of the best deals in the space, adjusting the stock valuation by that growth. And here's a stock we haven't talked about before, but Bitmine Immersion Technologies, ticker BMNR, could see strong upside demand over the next few weeks ahead of its addition to the Russell 1000 index on the 26th of June. That means ETFs like the iShares Russell 1000, ticker IWB, have to start buying those shares. On a $10.5 billion market cap for BMNR versus the roughly $55 trillion index market cap for all companies in that Russell index, that means Bitmine would be about 0.0181% weight, and with approximately $3 trillion in ETFs tracking the index, that equals buying pressure of about $550 million or 30 million shares. Now that represents an additional 5% institutional ownership from the current 37% owned and could go higher as other funds start adding the stock. Now here's where it gets interesting though. Because BMNR has tracked Ethereum over the last 3 months and in fact underperformed that underlying asset that it holds, we can assume that that additional buying just hasn't happened yet. It's not a massive demand spike, but could be the catalyst for more upside buying, and in crypto, that's sometimes all it takes to get things moving much higher. Broadcom, ticker AVGO, is the next big AI stock to report when it drops earnings on Wednesday. Now, I called this the next trillion-dollar company 4 years ago when it was just a $163 billion networking equipment maker, but even I didn't think it would jump 12 times your money to a $2 trillion company. The accelerator chip and networking giant is expected to report 47% revenue growth for the last quarter and guide to 78% growth this quarter, with a surprisingly strong 66% earnings growth this year. Now, this stock isn't cheap anymore after a 78% run just in the last year and priced at 30 times its sales. But the way those core AI hardware companies are reporting this quarter, we could see some strong numbers put up by Broadcom, and I'd be buying ahead of the report. Updating our stock market outlook, we will see the monthly jobs report on Friday with expectations for 90,000 jobs added in May versus 115,000 added the month before. Now, while the unemployment rate has crept higher and job additions are lower, it's not enough to force the Fed to lower rates against 4% inflation, so this report probably isn't likely going to be moving the market much. What could move the market over the next few months, though, is a deal to end the war in Iran, but maybe not in the direction investors expect. Stocks have jumped to new highs on the promise of a deal, but here it is Saturday and nothing has been finalized. The president last week said that negotiations were all but finished, then announced he would be making a decision on Friday. If he does agree to the negotiated terms, markets are likely to open higher this week. Now the problem is, that's when the hope of returning back to normal runs headlong into reality. Oil prices have already come down 17% from the peak, and gas prices are down about 15 cents over the last week. But clearing out the hundreds of ships stuck in the strait isn't going to happen overnight, especially given the mines laid by Iran that are going to need to be removed before that waterway can fully reopen. An analyst at logistics firm Kepler estimates full tanker capacity could take up to 3 months for the strait to handle that average 80 to 130 ships a day. And even as the strait restarts tanker traffic, first oil is going to be pulled from those inventories that were almost filled to capacity, and oil wells that were slowed or outright stopped are going to need to be slowly restarted. That takes time and is going to mean global oil production could lag hopes of a quick return to normal. Now, against all of this, there's also the reality that very little has been changed by the deal with Iran. Now, we don't have every detail, but reporting on the negotiated terms are that Iran won't be required to give up its enriched uranium or to stop nuclear activities. On top of this, Iran could be getting a major lifeline in unfrozen assets and removed sanctions. Now, there will be no doubt over the next 60 days when both sides threaten to renew those hostilities, and the market is going to react. The VIX Volatility Index, the market's fear gauge, has dropped to almost the lowest of the year, and I think investors are just being complacent here. It's exactly during times like this when investors get overexcited and assume that stocks are only heading higher that the market turns around and bites you in the ass. So again, after that 19% run in just 2 months and stocks at record highs, make sure you're ready for that. Join me on the Blossom Investing app free with the special invite link in the description. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.